Well, I guess has been pushed aside and has been always lingering as a potential threat. Geopolitical risks are always something that you have to be mindful of when you're building your scenarios for the future, really. But I guess the timing of it was certainly surprising for the markets. And it's coming at a potentially not the best time for the global economy. We have global PMIs really coming under renewed pressure, still reeling from the from the trade war between the US and China we had to deal with until not so long ago. So from that point of view, I think the timing of the shock that we're experiencing at the moment may be potentially the one thing we should be focusing on, and its economic impact via higher oil prices and tighter global financial conditions.
I'm going to say something which may be controversial on this day, but just purely in terms of the oil price, it's not really moved that much, I would suggest, given people are historically concerned about the ramifications of conflict on either side of the Straits of Hormuz, and the amount of oil traffic that goes through that and the crippling effects that could have for the global economy. To see Brent crude and WTI, and this is a fantastic chart because it really sums up for me that WTI has just moved at best to the mean of its move over the last 2 years as well. I would suggest the world is potentially swimming in oil. We saw the OPEC cuts late last year as well. It seems extraordinary to me that even despite concern about a ratcheting up of tension, we've only seen such a modest move in the price of crude.
Well, I guess maybe it's a bit early to draw the really final conclusions here about the overall impact on oil. After all, we just had the OPEC meeting where they reaffirmed cutting production further. At the same time, we also have expectations of oil output really peaking this year. So chances are that the move may continue, and that latest development.
Talking about non-OPEC supply potentially and US shale output potential, and it's a well-trodden view, and we'll have to see how that pans out as well. But for me, whether you're looking at your domain, which is the foreign exchange world, or this commodity world, or even the equity market move now, something that I've looked at my entire career is it's very, very difficult to trade and to comment on what the market will do on the back of a geopolitical event. So my caution to our viewers, and I wonder if you'd echo that, would be don't get too carried away about what you think the natural reactions are of market assets to geopolitical events.
No, it's the case. I mean, there's always emphasizing the timing of it rather than the actual shock as such. It is the case that we just had some PMIs out of China early in the week, the Eurozone, obviously the UK, and the data is not stellar. It is the case that the global economy is not in its best shape here. So from that point of view, the last thing you need right now, where the global economy is significantly much higher oil prices, which could translate into, if you wish, unwarranted tightening in the global financial conditions. As regards the actual impact, I mean, there are mitigating circumstances there. We do have the Fed really pumping dollar liquidity in the market on a daily basis. We have the repo auctions. We have 60 billion worth of money really flowing into the markets. We have other central banks really committing to more really dovish policy measures and so on and so forth. Either way, I guess the future will only tell what the overall impact is going to be. But what I'm trying to emphasize here is that the timing of it is somewhat unfortunate for the market. So we could see some de-risking continuing. Obviously, it's the end of the week, start of the new week, really, or the year will be really next week. But the point being that investors, that will likely open on a more cautious tone.
But how high is the risk of a sustained elevated price of oil for the global economy? To Steve's point, that we're essentially awash with oil at the moment because US shales completely changed the dynamic for supply and demand. Can we make up the shortfall easily?
Clearly demand and supply driven, and to your point, it is the case that demand hasn't been that great, where supply, really the adjustment we've seen from OPEC were triggered partly because of the insufficient demand there. So from that point of view, chances are that the spikes or the spike we're seeing may not be the beginning of a new uptrend in oil prices.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.